Welcome everyone to QB Power Hour. Today is October 19th. Today's episode is journal entries and zero net transactions in QuickBooks Desktop Part 1. What's interesting about this Part 1 deal is that at first I thought journal entries, I don't think I could do a whole hour on journal entries. And then I started thinking about it, and as I dig really deep and I asked people in the Facebook group, it turns out that there's a whole bunch of things, issues and reporting problems, workarounds with journal entries. And as I started sort of numerating all the issues, I noticed that this could actually be a 3-part series. But I'm thinking that it may just be a 2-part series, by the way. But well, we'll see. We'll see as it goes. Let's see how much we get done today, and then we'll see on the next episode, which will probably be in January at some point, Part 2. The agenda for today, we'll spend a couple of minutes talking about QB Power Hour, the host, the CPE process, and our sponsors. The topics will be learn how journal entries affect the accounting reports in both cash and accrual basis. The stuff that I'll show you on that may blow your mind. And understand what alternatives are to journal entries that achieve the same reports. These are the famous zero net transactions. And that will take about 50 minutes, and we'll spend 5 minutes in Q&A. So QB Power Hour, it's a webinar series if you're joining us for the first time, usually twice a month or every other week. It's always on a Thursday at 12 p.m. The next episode will be exactly in 2 weeks, November 2nd, and we'll do a deep dive with T-Sheets in 2 specific features that I love, which is scheduling and kiosk time clock, which are the lesser known T-Sheets features. Most people know T-Sheets for other things. So we'll cover those. And then 2 weeks, actually, a month later, so I believe that's 4 weeks later. So we're going to have a whole gap between November 2nd and the 30th. We'll do trends in the accounting technology industry, and then we'll have a special guest about workflow management. Then we're going to bring in some of the learnings that we bring from QB Connect, because we are going to go to QB Connect, Michelle and I. And usually we talk about tips, tricks, advanced insights, 50% QuickBooks Online, 50% QuickBooks Desktop. Today it's just desktop, so we'll be 100% focused on desktop. Michelle Long is not with us today. She's actually teaching a QuickBooks Online certification class somewhere. I don't know where it is. Check her out. She's an author. She has a huge following in LinkedIn, 165,000 members, and she's got 5 books. They're all sold in Amazon. My name is Hector Garcia. I live and work in Miami, Florida. As a matter of fact, very rarely I do these webinars from my office. I usually do it from my house, and I actually happen to be at my office, and I'm in Miami, so I got this thing to show you that I'm in Miami. my Miami artwork right there in the back that I got from IKEA. Anyway, I have my email address is on the screen. There's my Twitter handle if you want to contact me. Now, this is a CPE class. If you need CPE, if you're an accountant, a certified bookkeeper, or someone that needs that credit, you must attend the webinar live, not available in recordings. You must be logged in for at least 50 minutes. We'll ask 4 polling questions in total. You have to answer at least 3 to get your credit. You will get an email with an email version of the certificate within 3 weeks. And this episode is approved for ACE. It is approved for ACE. There's a AutoValue Conference in Texas, November 8th and 9th. Check them out. If you're going to learn value pricing, this is probably the best place to do it in. QuickBooks Connect Conference in San Jose, California, QuickBooksConnect.com. Michelle and I will both be there. If you go there, pass by and say hello. Let's see what we got here. And Scaling New Heights, that will be next year in June. Thank you to our sponsors, T-Sheets, #1 rated app in apps.com to create, manage, and approve timesheets from any device. Tsheets.com/pros. Get your free account for your practice. Arrow Workflow, the only workflow manager created by QuickBooks Pro Advisors for Pro Advisors. Great workflow software. We use it in our practice. It integrates with QuickBooks Online, arrowworkflow.com. And HubDoc, the most popular document aggregator for QuickBooks Power users, automate downloading your bank statements and other bills, all directly through HubDoc. If you go to hubdoc.com/QB Power Hour, you get a free account for your practice. Now let's talk about the topics. I'm thinking that this will be a two-part series. We'll see how far we get today. Part one, I'm going to briefly talk about debit and credit cheat sheet. This is how I personally remembered or learned debits and credits in college. So I'll show you that. Then I'll talk about why and why not do journal entries. We'll talk about the adjusting journal entry. We'll talk about the most important piece, which is source and detail lines in a journal entry. We'll talk about applying payments to open journal entries for AP and AR, transferring balances across jobs, transferring balances across accounts, receivables and payables using a barter account, and zero net transactions. So maybe we'll get to all this. Maybe we'll get to a few. So just so you know, if we don't, it's fine. There's enough meat to cover on this. And if it does, it may turn into a three-part series. And so be it if it does. Okay, so let's start with debits and credits cheat sheet. So I want to talk to you about this real quick. Most accountants here, we have a whole bunch of accountants in this webinar. I think 90% of you would be know this by heart. If it's an asset or an expense, it's a debit account. If it's a liability, income, or equity, it's a credit account. The problem is most of us learn this through memorization, and this is hard to explain, especially because debits and expenses on the same side don't really make much sense. Like, why are you grouping assets and expenses in the same place? And that's really what causes confusion. So I had one professor explain it this way, and hopefully this will stick with you forever, and then you will never have to think about debits and credits ever again. They become instinctively. So if you go get a home equity loan, what's equity mean? Well, equity means the value of your house minus your mortgage. So naturally, the equation of equity equals assets minus liability, that should click with everyone, even non-accountants. This will be very useful, especially if you have to explain debits and credits to people. Now, the same equation flipped around, just doing, moving signs around, equity plus liability equals assets. And normally, this actually taught the third way, which is assets equals liabilities plus equity. So most people know that the last formula, but they don't explain it, starting from equity equals assets minus liabilities, because that makes the most sense to the average person. Now, if you were to break down equity is two things. It is capital and it's retained earnings. So the formula now is assets equals liabilities plus capital plus retained earnings. If you were to change the word retained earnings for what it really is, it's net income. So then assets equals liabilities plus capital plus net income. So at that point, you should be doing just fine. Now, this is the part where what I think it makes the most sense. The reason why assets and expenses are grouped together is because net income is actually income minus expenses. So if you were to draw out a formula, and we use the second formula, assets equals liabilities plus equity plus income minus expenses, all you would have to do is basic algebra, move the negative sign variables from the right side to the left side, and then finally you get the final formula, which is assets plus expenses equals liability plus equity plus income, which leads to the reason why the left side, assets and expenses, are debits and they're grouped together, and the reason why liabilities, equity, and income are all credits and they're grouped together. So hopefully this may be just a review for most people, and most people are be like, okay, boring, I get it. But I wanted to kind of dig deep, especially for the folks that watch this webinar afterwards, record it, that may not be accounting professionals. Now, in QuickBooks terms, this may be probably something that you want to print and give to anyone that's in charge of doing journal entry, especially, again, if they don't come in 100% with experience of accounting or have these instincts for accounting, is if from QuickBooks terms, if the account that you're touching is a bank, an other current asset, a fixed asset, an other asset, an expense, or another asset, that should be a debit account. That means that you increase it through the debits, and vice versa, you decrease it to the credits. Now, onto the right side, on the credit side, anytime you're dealing with a credit card, other current liability, long-term liability, income, other income, and equity, anytime you're touching any of those accounts, they get increased to the credit side, and obviously vice versa, decreased to the debit side. So this is an awesome cheat sheet to have. I actually print this to some of my customers in the event that we're asking them or requiring them to do some sort of journal entries. But for the most part, I don't have clients actually do journal entries. Okay, so let's talk about why journal entries. So one use case for journal entries, which I'm totally okay with, is entering beginning balances that come from another accounting system or come maybe from the balance sheet Schedule L from a tax return. The only issue is in a journal entry, normally you can adjust all beginning balances through it, but you wouldn't touch accounts receivable or accounts payable through it. And we'll kind of dig through the reason why accounts receivable and accounts payable is kind of scary with journal entries. And to take it one step further, sales tax, payroll liabilities, and inventory as well. But the reason why you do a journal entry is because you need to, the real reason, especially when we're talking about real-time transactions, is because we need to adjust the balance or the value of any accounts that are not deriving from cash. So any transactions deriving from cash, which is either a bank or a credit card, which is negative cash, or bizarro cash. So anything that touches a bank or a credit card, you must use a natural transaction, a check, a deposit, a credit card charge. But if it's not deriving from a bank, then we need a journal entry. We don't have a choice. We have to use a journal entry to transfer value or balances between accounts. And these have to balance debits and credits because the money doesn't, money's not born out of nowhere, where it's not disappearing. It either comes from somewhere or goes to a place. And that's what the double entry accounting system's for, is for you to record, hey, where the money came from, where the money is going to, in terms of changing value. Now, the other reason why, common case where people use journal entries, it's okay to do journal entries, is to do timing differences. So a timing difference would be like a prepaid account. I receive a deposit and I have to convert it into income later on in the future, or I have to record depreciation, the reduction of value over time. So those are two use cases in which journal entries are totally okay, and for the most part, it's normal to have journal entries. Now, when do you want to avoid journal entries? Well, first of all, for inventory, you should never touch the inventory account. You should use an inventory valuation an inventory adjusting inventory quantity value on hand transaction, because in a journal entry you cannot use items. So there's no way to affect my item list of inventory via a journal entry, and I don't want to have a difference between my inventory asset and my actual item valuation report. So in order to do that, never, ever, ever touch your inventory account. Now, one exception to the rule is, let's say you have a QuickBooks user that doesn't track inventory in QuickBooks. They track it in an Excel spreadsheet and some other software, and they're just booking periodic inventory values. Then that's okay. You can hit inventory asset and you can hit cost of goods sold, totally okay, but that's specifically because they're not tracking inventory in QuickBooks. If they're tracking inventory in QuickBooks, it's an absolute no-no to touch the inventory asset account. Now, accounts payable and accounts receivable. Accounts payable really is because you may have an issue with open bills and stuff like that. And accounts receivable, most specific, has to do with sales tax and sales reports. Most QuickBooks sales reports are deriving from invoices and sales receipts, and accounts receivable don't play well with sales reports, and they also look really strange on a statement. So that's why you want to try not to use accounts receivable, and particularly because of sales tax, because people try to adjust open receivables through journal entries, and then what happens is they don't reverse a sales tax, so they basically inadvertently pay tax. And if the invoice is being written off, they're not getting that tax back. So that's a big issue. Sales tax liability report, because it doesn't show up on the report correctly. And the payroll tax liability report, really important that we don't touch it, is because any adjustments to that does not show up in the tax forms. Now, I do adjustments to tax liability accounts. I've done it before, but I know what I'm doing, and I'm extremely intentional about it. But in general terms, we don't want to do that. And lastly, you should never, ever, ever, ever hit the retained earnings account through a regular transaction or through a journal entry, with the one exception of entering a historical value, historical balance sheet, historical adjustment from a day before your QuickBooks start date. you can hit retained earnings all day long. But in a current scenario, in a current period, you can never touch retained earnings. Now, what are some of the alternatives to journal entries, which I was alluding to earlier? If you need to affect the inventory asset account, you must use the inventory quantity value on inventory on hand adjustment, right? Or if you're gonna affect your accounts payable account, use a bill if you need to increase it, use a bill credit if you need to decrease it, and use a bill payment if you need to decrease it against a bank or a credit card. Accounts receivable, you should always use an invoice, a credit memo, or a payment, never a journal entry. Sales tax liability, there's an actual form, it's hidden somewhere deep in the sales tax options called adjust sales tax liability. Always use that option, not a journal entry, because then the reports come out wrong. Same exact situation with the payroll tax liability. There's a hidden function somewhere deep in there called adjust payroll tax liability. You should use that. And again, when we talked about retained earnings, you should not, you should not use any transaction for retained earnings. But if you're going to use it on a journal entry, which is the only case in which I'm okay with using retained earnings, it's only because I'm entering a historical transaction from a previously closed period. Back to the slides. So what are some of the alternatives to journal entries? Continuing on the same theme. So if I need to make an adjustment across two profit and loss accounts, for example, I need to reduce my meals and entertainment and move it to travel or something like that, I personally prefer that you don't make an overall adjustment, that you actually use the batch reclassify tool. Because when you do a journal entry to a P&L account, it's a really crummy audit trail. And if you've ever been in an IRS audit in which they're auditing a particular account balance and there's been journal entries hitting to it, it's a complete nightmare to try to explain that to an auditor. So you want to use the actual batch reclassify tool instead of making a journal entry. That way you can get full historical transactions to each of those accounts, and you can actually justify them to an audit, especially for an IRS audit. I would say avoid doing journal entries to P&L accounts. Now, moving money across two bank accounts or across two balance sheet accounts, I would actually prefer to use the transfer feature. Again, the least amount of journal entries that we can create, the better. The transfer feature does have an issue that you can't select a vendor or a customer. So if you're trying to record a vendor or a customer as part of the transfer, you don't get it with the transfer. You could do it with the journal entry. But if you're just moving money across bank accounts, there really shouldn't be a customer or a vendor being tagged from there. So that's just a really important piece. And then if you need to originate any transaction from a balance sheet account, that's going to be a journal entry automatically. So you can't avoid it. So if you go into the register and go straight to the journal to any balance sheet account, and you create an adjustment there, that will create a journal entry for you. Okay. So let's go up in QuickBooks and let's go through the rest of the topics. So let me pull up a profit and loss report for today, and then we're going to be using the profit and loss report and the balance sheet report to kind of see what's going on as I do these journal entries. So let me do this today as well, and then I'll do a comparative with yesterday and a dollar change. Okay, so that should give me a good idea of what's going on with the balances as I do the transaction. So I'm going to show you. First thing I'm going to do is I'm going to make an adjustment. Let's say, for example, from inventory asset into cost of goods sold, which, by the way, I said that you should never do that. You should do it with items, but I'll do it anyway to illustrate the point. So I'm going to go into company, make journal entries, and then I'm going to go from inventory asset, and I'll remove $20,000 from it, and then I'm going to go into cost of goods sold, and I'm going to increase my expense by $20,000. I'm going to click, this little thing that says adjusting entry, I'm going to uncheck it for a second just so I can show you something, and then I'm going to click on save. So there it is. There's my reduction of my inventory asset. There's my cost of goods sold. Right? Instantly making changes to my books. Now, this little check mark here, it's amazing. It's, believe it or not, most people think it's useless. That's actually amazing. That little check mark should only be used by the accountant to tell either the user or the accountant that this journal entry came from an accountant doing it for the purpose of adjusting. Now, adjusting is different than doing an actual transaction. Like, for example, if I were to do a transaction like making a payment from my checking account into my loan, for example, and that happens to be an actual real transaction, that's technically not an adjustment. That's actually a transaction that's causing this. But what I'm doing here is I'm reducing my inventory by 20,000 because for whatever reason, my customer told me, hey, my inventory is overstated and I need to adjust it, and you're making that adjustment. So this is truly an adjustment. And the reason why I want to mark it adjusting entry is for two reasons. I'm going to hit save here for a second. One is because if I ever want to pull a report that omits adjustments, I can click on Customize Report, click on Filters, go down here to Is Adjustment, and click on No, and I'll hit OK. And basically, it will have the same profit and loss without that. Now, I'm going to show you this with the whole month because it may be just much easier to see it right here. So I got the whole month here. Pay attention to my cost of goods sold, which is $288. When I click on Customize Report, click on Filter, and then under Is Adjustment, I'll put Either and hit OK. That is going to include my adjustment there, right? And what's even awesomer, in my opinion, it's an awesome word to use. What's even awesomer is if I use Is Adjustment and click Yes and I hit OK, it will only show me my journal entries that I've done with adjustments of value. So if you wanted to quickly evaluate, hey, what has been the accumulated changes to my net income over a year? Let me do here a whole year, this fiscal year. So if I want to know what the accumulated changes to my net income, to my net profit results due to journal entries, you can see it here. And if that dollar amount is huge, just know that your IRS audit would be a lot more complicated than it would be if you hadn't done that. So that's actually a really important piece, and I think that it gives you a lot of insight to pull a P&L by just including the adjusting entries. Now, if I click on Customize Report, click on Filters, go back to Is Adjustment and click Either, obviously that's going to include all the transactions. It's not going to include only the adjusting journal entries, but on the same P&L, I can click on Customize Report, click on Filters, and then I can click Transaction Type, and then I can select Journal and hit OK. Now this may give me a different number, and there it is. So this tells me what is my effect to net income based on all my journal entries, right? So now I can see, okay, my net income has been affected by 33,000 based on journal entries. And if I click on Customize Report, Filters, and again, I go back to that Is Adjustment and hit Yes. So now I can see all my journal entries affected by adjusting journal entries. So that's actually an awesome thing to see on reports. But there's even a better report called the Adjusted Trial Balance Report. So I'm going to click on Reports. I'm going to go to Accounting and Taxes, and I'm going to click on Adjusted Trial Balance. And this is a very underutilized, underrated report, which is actually pretty amazing. So I'm going to click on Adjusted Trial Balance. And what you're going to see here, let me do this fiscal year to date. What you're going to see here under Unadjusted Balance, this is what my profit and loss looks like, including journal entries, but excluding my journal entry adjustments. And then the middle one, it's the same as before, right? I get only my adjusting journal entries, and then I get as a result my adjusted trial balance, which is what does my balance sheet look like applying all of those adjusting journal entries. So that little checkbox, when I said that is awesome, is because it is absolutely awesome. It's because it gives you so much information, so much dimension. Just that little tiny checkbox that says adjusting entry gives you so much flavor. So the one thing you have to just make sure is that your customers, the end users, are not hitting that checkbox. Now with QuickBooks Pro Premier, easy, right? Because QuickBooks Pro Premier doesn't allow the user to check it. Only the external accountant can. So as long as they're logging in as an external accountant, they're the only ones that can put a checkbox in there. QuickBooks Enterprise, unfortunately, which is a big problem, has that box there for across all users. So anyone can do journal entries, will be able to do that. So I have a little trick that I do, which assuming that I'm very intentional about using this adjusting entry tool is I create a report here. I go to customize reports and click transaction detail. And then I click on dates all. And then I click on filters. And then I go to transaction type. And then I click on journal. And then I'm going to click on is adjustment. And I'm going to click on yes. And I'm going to hit OK. So this report gives me a history of all the journal entries that have been created that have that adjustment checkbox. And then I click on customize report. And then I click on this little checkbox that says enter last modified and modified by. And I hit OK. And I usually memorize this report. And I go up and down to see if my customer, my client, has been the one doing that. So this is only relevant for QuickBooks Enterprise users that have the capacity to check that box. But with this report, you can quickly audit and see, hey, wait a second, my customer is doing adjusting entries. You have to make sure that they're not doing it. Again, if you're being intentional about using that little checkbox. Okay. Perfect. Let's see. Let me close that. Okay, so that's adjusting journal entries. Let's see what the next topic is. Source versus detail lines. Man, this is, you're going to be blown away by this if this is new information for you. So let me come in here and pull up a P&L again. And I'm going to do today. So let's go to today's date. Let me go to a balance sheet again and pull up today as well. And I'll do the comparison so we can see exactly what's going on here. And then we'll do window tile vertically, okay? And I'm gonna go ahead and delete that journal entry that was here. Now this is about to blow your mind. So get ready, focus, get any distractions that potentially are in front of you right now. So I'm gonna make a journal entry right now. So I'm gonna do company, make journal entry. I'm going to make a journal entry where the source of the transaction, it's a type of account that is affected by cash versus accrual basis. So I'm going to make accounts receivable. Let's do accounts receivable, right? So I'm going to pick a customer here at random. I'll pick a customer here, and then I'm going to adjust $12,000. So in this particular case, I'm decreasing my accounts receivable, and then I'm going to go ahead and book my sales. Again, I would never recommend this, but if you're doing this and you're paying attention to what I'm about to do, you're going to notice something that may be happening to your QuickBooks file now that you may not understand too well, and at this point you will. So I'm doing a journal entry in which I am affecting my accounts receivable, and then I'm going to go ahead and click save. Now, as you're expecting, my income was affected and my accounts receivable is affected. Now, if I switch this report from accrual to cash basis, nothing happens. Same thing here, nothing happens. The reason for that is because there's no application of payment to that journal entry. So the only way that on a cash basis report, that journal entry will show up that is hitting accounts receivable is if it's being applied to an invoice, to a credit memo, or to a payment. It needs to be applied to something in order to show up. So let me show you what would happen. So again, I'm in the cash basis report, and I'm looking at the effects of a journal entry that was affecting accounts receivable. So I'm going to go to customers. I'm going to click on receive payment. I'll pick this customer here. I'll receive the $12,000. So the right customer. Of course, don't remember that customer that I used. So I used Northeast Wholesale, okay? So here's my $12,000. Actually, what adjustment did I reduce accounts receivable? So I'll do an invoice instead. Sorry about that. I'll create the invoice. I'll select Northeast Wholesalers. I'll pick an item at random. Let's pick this guy and make this, let's say, $8,000. So I'm making it purposefully a different dollar amount so we see exactly what's going on. So I'm going to click on save. Let me not email this. Done. Now, notice that on an accrual basis report, I got my invoice of $8,000, and then I have my journal entry here because I'm looking at an accrual basis report. If I click on cash, I get nothing, again, because I haven't applied the payment. So if I actually go and apply this payment, so I'm going to go to customers, receive payment, and I'm going to go look for the $8,000 here and click on discounts and credits. And I come in and apply the payment. Again, cash basis reports are based on applied payment. So if I go and apply a payment, which basically was the adjustment to the journal entry. So if I apply the adjustment to journal entry an invoice, then all of a sudden on my cash basis report, I do get the transaction. But again, because I adjusted it, it comes right back, right? So, I mean, this is one of the really strange things about journal entries. This is why I never want to use a journal entry for accounts receivable. Now, I'm going to show you something that's even more interesting. I'm going to go ahead and delete this invoice altogether. Okay, so we should be back to the accrual basis report showing me the 12,000 and the cash basis report showing me nothing. Now I'm going to go to this journal entry. Let me go to it. Okay, open it up. So I'm going to do this journal entry, and again, in cash basis, nothing's being shown because of the application of payments. And then on accrual payments, on the accrual report, it is showing the adjustment. Now I'm going to do something that's going to be very strange. I'm going to change the order of these things. So I'm going to delete the line, and now I'm using as the top line, this is the source transaction. I'm not using accounts receivable. I'm using the income account. Now I'm going to flip it and put accounts receivable on the bottom line. Now, by the way, this is the exact same journal entry. There's no difference between the one I just did and this one. However, in the QuickBooks eyes, there's a hell of a lot of differences. In QuickBooks eyes, the source line, which is the very first line in the journal entry, is not the accounts receivable. Therefore, any accounts receivable adjustments or accounts payable adjustments we make in a journal entry in which the source account is not the accounts receivable account itself or the accounts payable, this will actually show up in a cash basis report. So when I click on save, okay, and I pick the customer here, Northeast Distributors, hit save, right? My accrual basis report is the same because again, it's the same exact journal entry. But when I go to cash, you will notice that it does show up in a cash report. Look, I'm switching from cash to accrual, and it is showing up in both. Again, in a journal entry, which we're looking at it here, the source of the transaction is the very first line, and the split or the details are the second line to whatever line the journal entry is. If the source is a receivable or a payable account, it will interact correctly in cash and accrual basis report. But if the source is not a receivable or a payable account, it will instantly hit, even in a cash basis report, whether or not this is not paid for. So this is one of the great mysteries of why the cash basis reports in the balance sheets are all jacked up. And in most cases, it's because these type of things, and unless you're sitting there tinkering with this and testing it and seeing the effects of it, you're never really going to know that this is going to happen. So it's something that I remember it from a conference a long time ago. But it never really clicked until I actually sat there and tested it. Now I want to show you something else that's interesting about this whole concept of source and destination. I'm gonna hit delete here for a second, and I'm gonna go ahead and I'm gonna go to reports, custom reports, transaction detail, and then I'm gonna click today and hit OK. Okay, so I got no transactions for today. So I'm gonna show you something pretty awesome. And this is also having to do mostly with the source detail stuff. So I'm going to make another journal entry. I'm going to pick, let's say, this account, and then I'm going to pick this account. And yes, I'm picking accounts at random here. And that, not accounts payable, that account. So I'm going to move $20,000 from here, put 5 in this one, and then 10 in this one. Okay, and I'm going to hit save. 5 and then 15 on this one. Whoops. Kind of accountant makes that mistake. Okay, so we hit save, and hit yes, and there's my report. So notice that in my report, I got my 3 lines. I have land, I have retainage, and I have workers' compensation. Now, the reason why land says split next to it, okay, and this is as important as it gets in terms, especially when you're building custom reports for clients. Let me zoom this in a little bit. The reason why land says split next to it is because land is my source. It is my source, and by definition, the source line of a QuickBooks transaction, unless the journal entry happens to have only one line, it's going to say split, and that's it. But notice what's really interesting about this is that on retainage receivable, it doesn't say split. It actually says land. Again, this is because of the source. So on the split side, any detail line. So let me just make this a little bit more obvious here. So let me maximize the size of this screen, and then bring the journal entry under it. So any second, third, fourth, whatever, any of these lines will always show in the split side the source of it. And then any source lines, which is the first line of the journal entry, will always show as a split the word split. And there's no way around it. Now, if you wanted to kind of take this one step further and do a journal entry in which it's pretty much as clean as it gets, where you don't have this issue with having the accounts receivable, accounts payable, source, destination, what we always do is create the first line as a bank account. So we created a bank account here called journal entry, and that could have a dollar value or could not. It doesn't really matter. If you make the first line an account called journal entry, a bank account called journal entry, every single line in your journal entry it's basically a detail line. That means that none of the information in terms of split and stuff will come in here. It will just say a generic name like journal entry. Again, I created a bank account called journal entry. So I'm going to click on save, and I want to show you how that looks different on the reports. See? So now I'm looking at a report in which I have all my accounts, and in split it all says journal entry instead of that pesky split line, letting you know that there's no direct correlation between one line and another account, because the math is not right. Because if you were to leave an account there, you would be thinking or assuming that you took $5,000 out of retainage receivables and it went to land, and that's not true. It went to a whole bunch of accounts, and this is especially true when you have multiple debits and multiple credits. So let me take it one step further here. So I'm going to insert a line here, and then I'll pick another account here, and then I'm going to make this, let's say, 4,000. Okay, and then I'll make this one 19,000. Right? I'm making the math even more jumbled up, and I'm going to delete this line. Whoops, not that one. Let me delete just the line and hit save. Okay, this is actually a much better example. So when we look at this line, and especially if we're looking at this line isolated, and maybe I'm not looking at the entire journal entry, maybe I'm looking at just one line item from the journal entry, I'm gonna get conflicting information, and this is gonna make a lot of sense when I do filters, and maybe I'm looking at just income and expenses. For example, let's say I'm not looking at the balance sheet side, I'm looking at income and expenses, like a P&L detail report. Let me see, is that right? Let's see, income and expense accounts. I don't know why that wasn't showing up, but just for a second, just look at one line. Look at retainage receivable. So according to this, we have $5,000 of retainage receivable, and then the split is land. So you're automatically assuming that $5,000 went to land. At the same time, if you look at workers' compensation, you have $19,000 of a credit. You would assume that the $19,000 completely went to land, which is not the case. It was actually split up across two accounts. What if this looked like this? Okay, 12,000 and 12,000, and then hit save. And we're looking at the same report. And again, if we're just looking at one line, let's say we're splitting this up by account or something like that. So we're looking at it maybe not as one single transaction. When I'm sitting there and looking at retainage receivable, I automatically make the assumption that my credit was $5,000 to retainage receivable, and my debit was 5,000 to land, which is not the case. So again, to alleviate that, and I know that was very confusing, but to alleviate that, what we suggest to do is to never take a journal entry line for granted, especially with split an account, and create a bank account called journal entry, and make that the first line, the source line. That way, when you're looking at it, you're always seeing the word journal entry as split, letting you know or forcing your thinking that the other side of that transaction is not any account in particular. It could potentially be a group of accounts or a group adjustment. Now, this is also true for the memo side. So I'm going to show you, this is actually very interesting. So on the land side, I'm going to put a memo and I'm going to call it land memo. I'm just making it very clear here. So on the second line, I'm putting land memo and I'm going to hit save. That way, when we're looking at the report, we see on our memo side, land memo. We see it perfect, right? Now, if we actually look at security deposits, that's a blank, workers' comp is a blank, retainage receivable is a blank. Specifically as we designed it in the journal entry. Now, if I put a memo in the first line, in the source line of a journal entry, again, if I put a memo in the source line of a journal entry, so I'm going to call it source memo, QuickBooks automatically assumes that any blank memos in a journal entry should be replaced by the source memo. So I'm going to click save and I bring that up, and that becomes extremely, extremely confusing, because then it brings in the source memo and maybe that memo itself contextually wasn't what you wanted. So if that's what you want, if you want to fill it in with something, then perfect, then do it that way. But if that's not what you want, just remember not to put any memo on the first line that could potentially conflict with information on the second line. Now, this is especially true with vendor names. So I'm going to hit delete line for a second. I'm going to show you something. Let me pick another, I'm going to pick something else here. I'm going to pick accounts receivable. Okay, and this is where things get a little bit hairy. So I'm going to select the customer here under accounts receivable, and then I'm going to hit save. So I'm doing a journal entry in which I'm picking a customer on accounts receivable, and I'm putting it on the source line. Now, what ended up happening is, now you look at this journal entry, every single line of that journal entry, it's citing the customer's name. And that could be confusing, because what does the customer name have to do with workers' comp? Or what does the customer name have to do with whatever other account we're using, depreciation or whatever? So if you're going to mix in, especially customer names and vendor names, this is where you don't want, especially accounts receivable on the first line. Insert the line, I'll put the generic account again and hit save, and pay close attention. The customer names are going to go away. Hit save. They go away from there. So this is extremely important, extremely valuable, that if you're going to cite a customer name or a vendor name in a journal entry and you're putting it on the first line, know that every single line item will be associated with that customer or vendor. And that could cause a lot of confusion. That's a really important thing. And then I'm going to stay on the same topic, because this topic is really important. I'm going to delete this journal entry for a second. And I'm going to make a different type of journal entry. So let's say when I make a journal entry where I'm doing a combination of things. Let's say, for example, I'm adjusting the accounts payable by $5,000 with one of my vendors. And again, it comes to the heart of why not use journal entries with vendor accounts payable and accounts receivable, or anything that affects the vendor. So let's say here I'm going to go to cost of goods sold. Okay. But let's say on the same journal entry, I decided, because I wanted to be cute like this, I decided that I'm also going to adjust other things at the same time. So let's say, for example, I'm going to adjust my accumulated depreciation and my depreciation expense. So I decide it'll be nice for me to book my depreciation as well on the same entry. So I'm going to click on save. There's all my journal entries. Again, what's the problem? That VU contracting came in on every single expense. Now, what happens if I run, for example, a detail report in which I want to see all my expenses for my vendor VU contracting? Okay, and then I'm gonna go to, let's say, account, and I'll select, let's say, all expenses. where am I? All income and expense accounts. Hit OK. What ends up happening is that these journal entries, including the depreciation expense, shows up on that report. Let me give you a different way of seeing these. Let's say, for example, I'm looking at a profit and loss report, and then I decided to double click on net income and get a detailed report, and then I decided to switch the report to vendor. And I'm just kind of analyzing all my expenses by vendor. When I get to VU contracting, I got $12,000 of expenses for that vendor, which is if I'm not paying attention to it, I'm thinking that truly is $12,000 to that vendor, but it's not. The reason why it happened is because, again, I had the vendor's name on the source line of a journal entry, so it will bring that over. So that, that's just destroys report, basically. I got a really good question here. Does QBO have the same source line impact? So I'm going to say, I don't know. I'm going to assume it does, but I haven't made the time to actually do this whole thing in QBO. So I got about 7 people asking the exact same question. So for sure, I would say, now you got some fodder to practice. I really have no clue. Honestly, I wish I knew. I haven't had the chance to experiment on it. I don't tinker that much with QBO as much as I do with QuickBooks Desktop. Okay, let's see what else we got in our list of things. Okay, so we talked about applying payments to an open journal entry. So I used an example of that. And then let's talk about transferring balances across accounts payable and accounts receivable. So this is by far one of the most frustrating things to anyone, which is a general limitation that QuickBooks has. Let me run a receivables report. Let me collapse this, and then I'm going to run a payables report. Let's go to vendors, payables. Okay, and let's say that for whatever reason, and again, these are circumstances that customers can have all sorts of weird circumstances. Say for whatever reason, this customer, Northeast Wholesalers, says, hey, I'm going to go ahead and pay your vendor directly. I'm going to pay them $5,000 directly, okay? And your vendor here is China Gum. So they actually went ahead and they paid the vendor directly, and I paid one of your bills. Now what you must do is you must reduce the accounts receivable for Northeast Wholesalers and increase the account, or reduce the accounts payable for China Gum. So any accountant with a sound mind will do something as simple as this, right? I'm going to come here and do accounts payable, and then I'm going to reduce my accounts payable by $5,000, and this is for China Gum. And then I'm going to do accounts receivable, increase it by, let me do 5,000, not 50,000. I get zero happy sometimes. So, and then I'm going to come here and put Northeast. So any sound accountant with the right mind would say, yeah, this is exactly how the entry works. But then when I hit save, it doesn't work. QuickBooks doesn't let you have more than one AP or AR line in a journal entry. Okay, so so that in itself, it's always going to be a problem, and you can't do anything about it. QuickBooks Online fixed it, which is awesome, but in desktop, that's it. That's going to be a problem forever. So what I end up doing, usually most of the times, what I'll do is I'll have to create 2 entries. So I'll create one called balance transfer clearing. Okay, so I'll create a, let's say, a loan account, or you can do an other current asset. It doesn't really matter. Current asset, current liability. Some people like to use bank. You can do that. It actually doesn't matter. Any balance sheet account works. So I do an account called balance transfer clearing. At the end of the day, this is going to be a 0 balance anyway. So I hit save. So then I'm going to come in here, and then I'm going to move accounts payable to balance transfer clearing. I'm going to put here Northeast Food Wholesalers, and then I click on save. And then I immediately create another journal entry. So I start by clicking on reverse. This is typically the easiest way to go. So I click on reverse, and then I come here and I put accounts receivable, sorry. And then I select my other customer. So I do NE, and then on this side I will put, who was it? China Gum. Yeah. So as long as you do 2 journal entries and I click on the reverse button, you can remove the memo reverse or you can leave it. It really doesn't matter. And let me put here today's date and I hit save. And then when I go back into my reports, my accounts receivable went down by 5,000 and my accounts payable went down by 5,000. Now the most important piece here is if I go to the register and I go to my, what was it called? Balance transfer clearing account. So if I open that in my register, in my chart of accounts, I want to actually see the history. So I want to see the money coming in and the money coming out. And I want to see the vendor names up here. So this actually makes it very clear, very easy to understand. Obviously on the memo, you should have said, you know, customer paid my vendor's balance or something like that. Yeah, I should have done this originally on the journal entry, but just to show you. So this is kind of like the type of stuff that you want to have when to do that. So this is the only, right now, this is the only feasible way to transfer balances from AP to AR is you have to do 2 journal entries and you have to go through the 2-step process. Now, let me talk about the alternative to journal entries, which is a zero net check. And the part 2 of this series will be focused 100% around the zero net check. So one of the alternatives they are to doing journal entries, assuming that journal entries for whatever reason are problematic or difficult to track. One of the things that people do is they'll create a check in which they're affecting both accounts at zero net. So for example, if I wanted to move money from fuel and gross wages for whatever reason, I will come in here and say, okay, I'm going to move 10,000 from here and then do negative 10,000. And what you're seeing here is the equivalent of a journal entry. I'm going to hit save here for a second. And when I say it's equivalent of journal entry, when I click Control Y, I actually see the debit and the credit. So this will have in your books the exact same effect as a journal entry. Now, why would you want to do that? Normally for something like this, you really don't, because this is pointless. But the reason why you want to do it, and again, this is sort of the teaser introduction or the value of zero net checks, is because we want to affect an item. So one of the biggest drawbacks of journal entries is journal entries will mess up an item report. So if I'm going to run an inventory report in which I affected inventory, it will mess up the value, but it won't show up in the item report. So if you need to make modifications to your accounting via an item, because you want to affect a sales report or a cost report or whatever, you want to use a zero net check. So you want to pick, the 2 items, and typically this is not that good for inventory items. So you want to pick the 2 items that you want to affect and do the same thing, right? So if I wanted to remove $10,000 from one item and add it to the other one, I would do what looks like a journal entry, but really isn't, and move it around this way. That way I get to affect my items. And then the underlying account that will be affected by this, it's run or it's directed by this account. So whatever account is being hit here, so for example, this one's hitting labor income, and let me see what the other account is hitting. By the way, my shortcut for this is Control L. You hit Control L, it opens up the item list, and then Control E, and then this one's gonna hit. I'm gonna pick a different one together. Let me pick this one, mileage income, just so we see it. And I'm gonna hit OK and hit yes. So by doing a zero net check like this, in which I'm affecting 2 items that in turn affect 2 different accounts and in turn affect my item report, when I click on save, and I'm going to pull up my profit and loss for today and hit today, you're actually going to see the 10,000 coming in and 10,000 coming out. So that is the alternative of a journal entry, the zero net check. Let me run the last polling question here, and then we'll talk about the upcoming webinars right after. So having questions about, hey, can you go deeper into the zero net check and the reports? So that would be the next one. So whatever the part 2 of this series will be focused on the zero net checks. This is why I kind of used it as a teaser and as a starting point, because the zero net checks actually will also, I mean, if what you learned here was good in terms of journal entries, zero net checks will likely to be even better. So definitely wait for that, and It won't be this year, I don't think. We'll see, depending on what the schedule looks like. It may be January or so, but if we can squeeze it in this year, maybe December. We'll see for this part 2. Okay, perfect. So let's see what other questions I can answer. And I'll stay for a couple minutes at least answering questions. If you have to go, yeah, that's fine. You can go. But there's a whole bunch of questions here. So one person says, how on earth did I miss the importance of this for all these years? Yeah, Brenda, you're right. It's really important. To move balances from AR and AP, I prefer to use a credit memo and offset it with a bill credit and use the same item to make it easier. That's actually a great idea, Daniel. Thank you. I would suggest that too. That's actually really good as well. January is the worst month for webinars. Yeah, that's a good point. That's why I record them. Let me see. Why don't journal entries appear on the customer information screen under transactions? So they will appear if you use the source as the accounts receivable, Chris. So if you create a journal entry in which the source is the accounts receivable, the journal entry will show. But if it's not on the source, then it won't show. Let's see. Journal entries. Let's see. Does journal entry account have to be a bank account? Can it be an expense account? That first line could be anything, by the way. It doesn't have to be. So that first clearing account could be anything. So that's right. It doesn't have to be a bank account. Let me see. I think that's it for now in terms of answering questions. I know for a fact I didn't answer at least 100 questions. So just email me, because I had a feeling this webinar itself was gonna inspire a lot of questions. Anyway, so let's go through let's wrap this up and talk about the upcoming webinars. So upcoming episodes, we have November 2nd in 2 weeks, T-Sheets, deep dive into scheduling and kiosk. On November 30th, we'll try to make it a what we learned at QB Connect / trends in accounting technology. And then we'll bring Arrow Workflow for some workflow tips. December 14 right now is trending to be the episode for top QuickBooks and Accountants app for 2017. So we're putting that together. And then we're tentatively setting up the part 2 for this on January 18th. Probably the worst month to do a webinar, but it'll be recorded, or make the sacrifice and show up either way. All right, so thank you to our sponsors. T-Sheets, #1 rated app in apps.com. Create, manage, approve your timesheets from any device. T-Sheets.com, set up your free account if you're an accounting professional. Arrow Workflow integrates with QuickBooks Online. Only workflow manager for QuickBooks Pro Advisors, created by another Pro Advisor, or actually a group of Pro Advisors. ArrowWorkflow.com. And HubDoc, automate document aggregation from your clients. Set up a free account at HubDoc.com for your practice. Thank you very much for attending QB Power Hour. Join our Facebook group if you haven't done it yet. Best place to ask questions. There's literally thousands of people there eager to interact, ask questions, and answer questions. And also take a look at Michelle's LinkedIn group. Thank you very much, and you have a wonderful day.